Hi, I'm Susan Molloy with the Molloy Team at Compass. I'd like to talk to you today about rates. What we'd like to discuss is some of the really great programs that banks offer out there that can get you a lower rate so that you can take advantage of this great market with lower prices. So today, we are going to have Zack Tolmie from Citibank. Thanks for joining us today, Zack. Zack, let's start with this. Can you speak to us on buying points to lower your rate?
When you buy points, what you're doing is you're paying a one-time upfront fee now in order to get a lower interest rate for the lifetime of your mortgage. And 1 point is defined as 1% of the loan size. So if you have $1 million loan and you're buying 1 point, you're paying $10,000. If you have a $500,000 loan and you're buying 1 point, you'd pay $5,000. And generally speaking, for every 1 point that you pay, you'll typically decrease your interest rate by about 1/4%.
Is there a maximum number of points that you can buy?
Sometimes it's a little more, sometimes it's a little less, but generally speaking, it's around 2 points. And on a $1 million loan size, if you buy 1 point and you decrease your interest rate by around 1/4%, you would end up saving around $160 a month or so. So when you're deciding whether or not it makes sense to buy points, you calculate what you're paying up front and how much you'd save on a monthly basis, and then figure out how many years it would take to recoup that cost. On a $1 million loan size, it would take you around 5 years to recoup that upfront cost in points.
Another option that we haven't used as much recently are ARMs. Can you talk to us about what an ARM rate is?
An ARM is an adjustable rate mortgage. Most mortgages historically in the United States have been fixed rate mortgages, which means that the interest rate is fixed for the lifetime of the loan. It's never going to change. It's always going to stay the same. With an adjustable rate mortgage, the interest rate adjusts, as the name implies. So it's fixed for only a short period of time, typically a few years, and then every 6 months after that, the interest rate starts adjusting.
With a 10-in-1 ARM, when would the rate start adjusting?
The interest rate would start adjusting after 10 years, or for a 5-year ARM, it would start adjusting after 5 years. And generally, the interest rate is lower during that introductory fixed rate period, but when the rate starts to adjust after that 5 years or after that 10 years, you should expect that the interest rate is going to adjust upward, which means that your monthly mortgage payment would also adjust, sometimes significantly upward.
So I guess we would say that one of the benefits of using an ARM is either for people that are thinking this is maybe something they're going to stay in for 5 or 7 years, or now I think this leads us into refinancing. They could refinance that loan.
When you refinance, you're paying off your old loan with a completely new loan that has completely different terms. It's with a completely different bank. It could be with the same bank, but it could be with a completely different bank. It could have a completely different interest rate, completely different loan size. And if you had an adjustable rate mortgage before, you could have a fixed rate mortgage now. So it's a completely new loan with completely different terms than what your old loan was before. And when you refinance, it's typically because interest rates have improved and you want to get a lower interest rate and decrease your monthly mortgage payment. For a co-op, it's relatively inexpensive to refinance. It usually costs $3,000, maybe $4,000 to refinance.
And I know condos are a little bit different.
A condo is considered real property, which means you generally have to pay a mortgage tax and you'll have to pay for title fees, which can be more expensive than what it would be for a co-op. So to refinance the same condo might cost you $7,000 or $8,000.
I do know, because you talked to me about this, that there is a program out there in which you could not have to pay that mortgage tax.
Correct. Yeah, it's CEMA, C-E-M-A. And what a CEMA is it's where your old bank assigns the mortgage tax that you've already paid when you purchase the property to the new bank that's going to have your refinanced loan. So that way you don't have to pay that same mortgage tax again because you've already paid it.
Talk to me about, if you were buying points versus an ARM, which way would you go in this market?
If you decide to pay points, it's definitely more of a long-term option. It'll take around 5 years in that example that we talked about before, to recoup that upfront cost of paying points. So it's a long-term investment. Whereas an adjustable rate mortgage is sort of the opposite. You're choosing to save money now at the expense of paying more potentially later. Because right now mortgage rates are at their historic all-time high, we haven't seen them in the last decade be anywhere near as high as they are right now. It's generally believed that rates are probably going to decrease at some point. Generally speaking, most people think that rates are going to decrease at some point in the next 4, 5, 6 years. So for a lot of people, they are purchasing homes now with the expectation that even though their interest rate might be higher now, they're going to refinance into a lower interest rate at some point in the future. If it were me, I would not pay for points. I would consider either not paying points or getting an adjustable rate mortgage.
Some people say, well, I don't want to pay closing costs again. Is there a way to wrap that into your rate?
So there are 3 ways that you can do that. Number 1, you can pay the closing costs yourself in cash. Number 2 is you can roll the closing costs into the loan itself. So that way, if closing costs are $8,000, your loan size is $500,000. Your new loan is $508,000. You're not paying it directly, but you are paying it indirectly over time. And then the third way is instead of taking whatever the new market interest rate is, maybe the bank can offer you a slightly higher interest rate. So instead of a 4% interest rate in the future, you're refinancing into 4.25%. You're paying a little bit more in interest every month, but the bank would pay the closing costs for you in that case. So you're still saving a lot of money compared to what you are now, but maybe not as much money as you would if you wanted to pay the closing costs yourself.
I know that a lot of banks, including Citi, offer relationship discounts. Can you talk to us about what that looks like at Citi?
If you have at least $50,000 with Citibank, it can be either in a checking account, savings account, investments, or even an IRA, Citibank will give you a discount of 1/8% off of your interest rate. So you'll save money on your loan for the lifetime of the loan, based off of how much money you have at the time of closing, at least 1 second after closing. So you can't use these funds for the closing itself. You need to pay for your closing costs and down payment in cash and still have that $50,000 with Citibank.
Does that percentage discount go up the more money you have?
It does. So there are different tiers at $200,000, at $500,000, at $1 million, and then at $2 million. And especially in New York, where people move around jobs, maybe more than we'd like to, a lot of times people will have an old 401k that they can move over to Citibank into a rollover IRA and then use those funds to get a substantial discount on their interest rate.
I know a lot of banks have programs out there that can get you a lower rate. You guys have the Home Run program. Can you tell us a little bit about that one?
The Home Run program is for people that are purchasing their primary residence and don't own any other property at the time of closing, and who are either making 120% or less of what the median income is for New York, or regardless of how much they make, are purchasing in a neighborhood that makes 120% or less of the median income in New York. In New York, that turns out to be around $118,000. So if either you make $118,000 or less a year, or regardless of how much you make, if you're purchasing in an area where people generally make $118,000 or less, you'd qualify for the Home Run program.
And I do know those neighborhoods are totally based on the census.
Correct. Yep. It's based off of the 2020 census. And if you're doing the Home Run program, you will get a $7,500 credit toward your closing costs from Citibank. And you'll also get a better interest rate than what the market interest rate is. You'll usually save around a full % on your interest rate. And then lastly, as long as the building allows for it, you can put down less than 20% and not have to pay private mortgage insurance.
So there's one more program that you guys have. See, there's a lot of options out there. And this one could work for first-time home buyers. And it's the family buying rate.
If you are purchasing a property for a family member, so you're purchasing a property for your child or for your parent to live in as their primary residence, you can generally get a much better interest rate than what they would receive if they were to be on the mortgage themselves. They could still be an owner of the property, meaning they could be on the title or on the stock certificate of the home, but they wouldn't be able to be on the mortgage. And by not being on the mortgage, Don't ask me how, but they end up getting a much better interest rate than they would if they were to be on the mortgage.
You have limits on the conforming and non-conforming. Conforming being loans that meet the guidelines of Fannie Mae or Freddie Mac. Can you tell us a little bit about what those loans and guidelines are?
Fannie Mae and Freddie Mac are these quasi-governmental organizations that set the lending standards for mortgages in the United States. And for very complicated reasons that I won't go into here, whenever a bank can sell a loan to Fannie Mae or to Freddie Mac, they will sell the loan to Fannie Mae or Freddie Mac, which is interesting because it's actually more expensive to sell a loan to Fannie Mae or Freddie Mac, meaning that the interest rate that's offered on those are higher than what they would be if the bank were to hold the mortgage on their own books themselves. So through this family member second home program, those loans cannot be sold to Fannie Mae or Freddie Mac. So Citibank has to hold onto those loans on their own books, which means that they're actually able to offer a better interest rate than they would be able to otherwise.
Well, thanks, Zack. I appreciate you taking the time to speak with us and all our people out there who are listening to this. I hope that for all of you out there, you feel a little bit more confident in being able to get yourself a better rate to take advantage of this amazing time in the real estate market. We look forward to seeing you guys soon. Give us a call with any questions.